Steve Peterson here with Infinity Investments, and welcome to our channel where we talk all things commercial and investment real estate. In today's video, we're going to talk about this concept called positive leverage. Positive leverage, meaning that we buy a property that generates enough income to where we make money on the bank's money. Bank lends us at a specific rate of interest, and the rate of return from the property is over and above that. So you're making money on the bank's money. That's positive leverage. Give you an example. Let's say you buy a property and the interest rate on that, I'll give real world, we in December 2022, interest rate 6.5%. If the property's generating a 7.5% cap rate, capitalization rate, meaning that the property, if there was no loan on it, yields the net operating income for the year, it yields 7.5%. It returns 7.5% on the purchase price and what you bought it for. All right, so the property is generating 7.5%. With that 7.5%, you pay your 6.5% mortgage, right? And you make money on the bank's money, and you make money on your money. So while in a situation where you can generate positive leverage, your rate of return, your cash on cash return is going to be higher than the cap rate of the building. Meaning that now I've utilized the loan to acquire the property, but not just to acquire the property, but also to increase the rate of return that I'm going to spend on the property. That is the core reason why real estate investments are, in my opinion, the best investment, right? And everybody can make a case for what they believe is the best. That's one of the reasons that I believe it's the best, right? You can not only make money on your money, but you can make money on the bank's money. And we're just talking cash flow. We're not talking about principal pay down. We're not talking about appreciation and growth and all of that. We're just talking about this concept of positive leverage. Now, here we are. Today is December 16th, 2022. Feds just raised the interest rates again, 50 basis points, 0.5%, which actually, by the way, y'all, is, in my opinion, we all knew they were going to raise the rates. It was a matter of how much. And it actually was a tapering down of how much they were going to raise the interest rates. They've been raising them by 4%, 75 basis points. So 50 basis points, not that bad. All right, we knew they were going to do it, so it's not bad. But here's the thing I wanted to talk about that I think is creating all the stagnation in commercial and investment properties right now, is because right now, today, and I'm in Oakland, California, the Bay Area, but most of NorCal, the cap rates, the property's rate of return, what it's yielding annually from a cash flow standpoint, is less than the going interest rates. So for people like me, brokers of the world that are selling properties, the biggest challenge that I'm seeing is not just the simple fact that the interest rates are high, but that the cap rates are, on average, lower than the interest rates. So for an investor, that means, hey, I'm going to put 30, 35% down, and I'm going to lose money on the bank's money instead of making money. And then what that does to my ROI, to my cash on cash, is that diminishes my cash on cash return, because now I'm essentially paying for the bank's money. Doesn't mean you're negative cash flow necessarily, depending on how much money you put down, but that means that the money you signed for, that you have a loan for, you're losing money, you're losing income on that, right? So it's very difficult to convince people to buy properties where there's negative leverage, all right? Positive leverage, this concept of positive leverage, is where the loan, the leverage, I'm making money on the bank's money. Positive leverage, very important. Negative leverage, I'm losing money on the bank's money. Doesn't mean I'm negative cash flow necessarily, but my rate of return is now diminished because the rate on the loan is higher than the rate of the property. And I just got to be honest with you, most investors do not want to acquire properties where there's negative leverage. And you would only do that if that's a short-term situation. You know you can raise the rents. Like, okay, for instance, in a rent control environment, that can be tough, right? You know you can value add. A lot of times people will do this going in because they know, hey, maybe there's 20, 30% vacancy. I can fill those vacant units. Maybe the property needs to get renovated. We can do that. We can increase the rents, so on and so forth. People who buy properties with private money a lot of times are doing value-added plays. So you might buy a property that's completely vacant, and so day one is negative leverage, there's no income in. But what you're doing is renovating it, and then when you lease it up and you bring on stabilized financing, now you're making serious positive leverage. All right, and so in the state of the market, why we're having so much stagnation is because right now, on average, that is, most people are not able to find properties where the rate is more than an interest rate. I do think that's going to change in 2023, right? I just think that at some point, cap rates got to come up, right? And then hopefully at some point, interest rates will come back down, but we don't know when that's going to happen. We can't bank on that. What we can do is look aggressively for the diamonds in the rough, the deals that are out there, because I'm starting to see them on a case-by-case basis, not on average, on a case-by-case basis where, 7.5% cap rate, 8% cap rate in Northern California, maybe not so much here in the Bay Area, but you are starting to see that, and I think you will see that in the Bay Area. That may mean values may dip a little bit, all right? And it all has to do with this concept of positive leverage. If we're going to put out money, if we're going to get a loan, we need to make money on that as investors and people in that community. Now, if you're selling a property, you got to understand that. You got to understand that, because as brokers, we can't wave a magic wand and make, the market give us the price we want. Boy, I wish we could. And last year, it felt like we were, right? Because everything you would list for sale would get multiple offers and sell above asking price. Well, there was 2% money all day long, right? At 6.5% and 7% money, it's a different situation. So we have to know, we got to understand that, and then we got to figure out, right? We got to figure out how we navigate through these, difficult and interesting times. And I think there's always a way, right? And there's I did some videos on the importance of, creative financing as method and means to be able to work with this. Assumable financing that's out there. There may be a loan that was done a couple years ago at 3%, 4% that you can assume, and the property is generating 5.5%. Now it makes some sense, or you can get the seller to carry financing. So you got to think creatively, but we got to understand what we're dealing with. If you don't understand what you're dealing with, like I coach football, youth football, but when we go into facing an opponent, I would like to be able to watch film on them if I can, because then I know, hey, this is what plays they're running, this is what they're doing, this is how we can combat that, right? So as investors, agents, people, professionals in the business, we've got to understand what the bottlenecks to the industry are and find solutions, ways that we can provide value, and thus make returns that we're going to beat the street, and we're going to have positive leverage on our deals. And I think we've all heard this thing, good debt and bad debt, right? The first core of that is, good debt is debt on assets that are going to generate you income, going to generate you more value. Bad debt is debt on liabilities, things that are going to take money out of you, cars, credit cards, student loans, things that are not going to produce value for you. You know what I mean? In general, when we take it a further step, when we look at a real estate investing, good debt is loans, mortgages that are going to generate you positive cash flow and growth. Bad debt is, and we call that positive leverage. Bad debt is where, hey, you are losing money on the bank's money. Hopefully you could be negative cash flow, for a lot of people are right now. And it is eating you, and it's eating your profits away. So just keep that in mind. I hope this helps. If it does, like, subscribe, share with friends. And then into the next video, hey, keep investing, keep your head up, look for ways to add value, and continue staying tapped in with us in this quality content. Hope you all, December 16th, hope you have an amazing holiday season. And to the next video. Peace.